AI data centers are incredibly hungry, but none of that compute matters if the data cannot physically travel, which is, well, exactly why Ciena just served up a massive 40% year-over-year revenue feast. Welcome to Earnings Unscripted. Today is June 4th, 2026, and we are unpacking the second quarter print for Ciena, ticker CIEN. Total revenue came in at $1.57 billion, and adjusted EPS hit $1.64, both up really nicely from last quarter. But Miro, looking at the tape today, the market is just completely punishing them this morning. What happened?
Yeah, it is. Well, the morning tape is pretty brutal. They dropped roughly 14% from yesterday's close, bottoming out around 490 intraday. But you really have to zoom out here to see the mechanics. The stock was on an absolute tear during the quarter itself. It gained, I think, over 115% and essentially closed near absolute highs right before earnings. So this is, frankly, just the classic reality check sell-off.
Right. Gravity always wins eventually. But looking at the actual numbers, it really does not look like a disaster at all. Operating income jumped 25% sequentially, and they expanded their adjusted gross margin to 44.9%.
No, that margin expansion is the entire story here. Everyone gets completely fixated on the GPU side of AI. But Ciena is essentially the physical toll collector on the data highway. They build the highly complex optical routing hardware that lets these hyperscaler clouds actually talk to each other. Routing and switching alone exploded 38% this quarter, and they pulled that off while facing serious component inflation by leaning on their, well, management calls it a value exchange.
I love that. A value exchange. That is just beautiful corporate speak for we are charging you more and you are going to pay it because you have zero alternatives. And actually, before I get too cynical here, quick reminder that this podcast is purely our personal opinion and definitely not financial advice. Do not go trading on my sarcasm. But seriously, they really have all the leverage right now, do they not?
They absolutely do. You cannot build a multi-billion-dollar compute cluster and then skimp on the optical fiber links, which is exactly why their total backlog just surged past $7.7 billion. Customers are explicitly telling Ciena that if they can take gear meant for 2027 and somehow manage to ship it early in 2026, they will immediately take delivery. There are essentially zero cancellations happening right now.
Wow. So it is the complete opposite of that COVID hangover where everyone hoarded inventory and then dumped it later. This is pure, desperate panic buying.
It is, yes, except, and this is where it gets really interesting, there is a major structural vulnerability hiding in all that demand. It turns out just two major cloud providers now make up 34% of total revenue. That's a massive chunk of your entire global operation tied directly to the budget whims of basically two companies.
Oh, wow. Okay, so that is either the ultimate golden goose or just a terrifying vulnerability if one of those giants decides to pull back. All right, let's get into the details on that.
It is completely terrifying if you are the one managing their risk profile. 34% is not just concentration. It is a strict dependency. But, well, if you look under the hood at the segment data, you actually see Ciena quietly trying to dilute that risk right now by leaning back into their old friends, the traditional service providers.
Right, the telcos, because they essentially stopped spending for a couple of years after the massive 5G build-out, right?
Yes, they vastly underinvested, but now they're being pulled back in through this concept called MOFN, that is Managed Optical Fiber Networks. It's a clever dynamic because hyperscalers are realizing they simply cannot build everything themselves.
Because you cannot just trench fiber across random municipalities on your own.
Exactly. And Gary Smith had a great quote on the call about this. He said, as omnipotent as some of the hyperscalers are, it's tough for them to be everywhere across the globe and also the last mile. So these traditional telcos are now stepping in to build physical networks explicitly on behalf of the cloud giants. Service provider revenue grew 28% year over year just catching that secondary wave.
That is such a fascinating power shift. It's like the big tech companies are basically renting the telcos to do the gritty physical work in the real world.
They have to. The physical bottlenecks out there are getting absurd. I was digging through the product transcripts, and there's this whole subplot about intermediary amplifier sites.
Intermediary amplifier sites. Okay. Can we please translate that into normal English?
Right. So when you're shooting a massive amount of AI data across a continent, the light signal naturally degrades. You need these little remote shacks out in the wild to boost the signal ever so often.
Just literal concrete shacks by the highway.
Pretty much. But the problem is physical space and thermal limits. You cannot infinitely cram more hardware into a tiny remote shack. The hyperscalers were hitting a hard physical wall here. So Ciena had to basically co-create a totally new solution for this.
So how do you fix a tiny shack without just pouring concrete and building a bigger shack?
You change how the light moves. They rolled out this architecture called RLS Hyper-Rail. It is their second-generation system. Instead of single paths, it bundles multiple fiber rails together. That drastically reduces the power and space required. And the big news this quarter, they finally booked their first major multi-rail contract with one of the hyperscalers to fix this exact real estate nightmare.
Okay, so that is not just an incremental spec bump. That is unlocking completely trapped capacity for AI model training.
Exactly. And the executive team stated the revenue rollout for multi-rail starting in 2027 is going to be linear. Though, I mean, if we are being honest, historical hardware transitions for Tier 1 cloud providers are famously lumpy. But regardless, it is a massive driver for that $7.7 billion backlog.
Sure, but wait, so everything is perfectly smooth then? There are no bottlenecks left for Ciena to worry about?
Oh, I wish. They fixed the space issue, but they are absolutely paying a price to manufacture the gear itself.
I was going to say, actually, operating expenses bumped up quite a bit. It was around $453 million on a GAAP basis.
Right. Ciena is unique because they make their own DSP modems in-house, which insulates them from that specific semiconductor shortage. But their line systems are heavily constrained by third-party pump lasers. They actually had to take a strategic bump in OpEx specifically to guarantee supplier shipments for those lasers. They're essentially paying silent premiums for priority lane access.
So they're throwing cash at suppliers to ensure they do not become the reason a hyperscaler cannot deploy next year.
Precisely. You protect the golden goose by overfeeding the farmers. And that premium also covers variable compensation because they crushed their internal revenue targets. They've also halted capitalizing share-based comp in inventory, which is, well, just minor accounting cleanup, but it shows really tight scrutiny on manufacturing expense allocation.
Which brings us back to that whole value exchange idea. If you're delivering the only product that solves a billion-dollar space constraint, you can easily pass those pump laser premiums onto your customer.
Exactly. That is how gross margins expanded to almost 45% in a highly inflationary hardware environment.
It really is just an incredible operational flex. But zooming out for a second, we should probably talk about who is actually orchestrating this cycle and what the forward guidance looks like. Because this was not just a normal quarter for the management team, right?
No, it really was not. I mean, you kind of have to step back and realize Gary Smith just led his 100th earnings call, 25 years as CEO.
Wow, so he has basically lived through every single hardware hype cycle.
Yeah, from the dot-com bust all the way to this generative AI phase. Surviving a quarter century in telecom hardware is, honestly, it is almost structurally impossible.
That is fair, which I guess makes their guidance even more fascinating. They did raise the full-year outlook, right?
They did. They bumped the full-year revenue midpoint to right around $6.3 billion. So that is roughly 32% year-over-year growth. And Q3 specifically is targeting $1.625 billion.
Okay, so they are definitely not sweating any immediate pullback from those massive cloud giants.
Not at all. The CFO actually pointed to their total addressable market doubling to $50 billion by 2029. He specifically called out durable, robust demand driven by AI.
Right, but there's always a catch with that kind of scale. I was looking at the analyst Q&A, and did someone not flag a weird detail about the back half margins?
Yes, Sean O'Loughlin caught that. Ciena pinned their full-year gross margin target firmly between 44.5 and 45%. But if you do the math, that full-year guide actually implies a downtick in Q4 margins.
Interesting. So just a tiny tea leaf of trouble then?
Exactly. Management called it simply being prudent about inflationary pressures, which probably just means uncertainty around those new U.S. tariffs or paying extra to secure pump lasers, but it is absolutely the big metric to watch.
For sure. So the real test is whether they can navigate inflation to actually build these orders without crushing their margins by 2027.
Pretty much. They claim the Hyper-Rail rollout will be linear, but hardware transitions for cloud players are notoriously lumpy.
Well, if anyone knows how to survive a bumpy cycle, it is probably the guy taking his 100th earnings lap.
We'll have the models updated for call 101.
I would expect nothing less. We'll leave it right there for today. Catch you next time, everyone.
See you later.
And just before we fully wrap up, if you want these breakdowns to just pop right into your feed, feel free to follow the show. Also, as a quick reminder, this podcast is actually generated using AI to see if we can make dense financial data sound like a real, natural human conversation. We would absolutely love your feedback or any ticker requests, so just shoot us an email at earningsunscripted@datamadness.ca or, grab that X link down in the show notes.
Thanks for listening, everyone.